So what do you say to the haters out there that look at guys like Donald Trump or Elon Musk and they're like, wealthy, don't pay taxes?
That's poor middle class behavior. You'll stay in the poor middle class if you constantly have that attitude. Why them? Why not me? This system is so unfair. I just can't even be around people that act like that. People who find success are naturally curious. They don't sit there and question, well, he must be doing something illegal. They sit there and think, how did he do it? How did he figure out what's the strategy? What's the play? They think intuitively.
What's the craziest thing somebody's ever tried to have you write off for them?
Young people try to write off Rolexes, APs all the time because they're doing videos with their watches on. And it's marketing. It's part of my brand. Of course it's going to be a write-off. The more I wear this, the more I have my Lamborghini, the more clients I'm attracting. I literally can see it. I see it inside of my Stripe account. Guess what? IRS doesn't care about your Stripe account, buddy. They care about facts and circumstances.
If you get a letter in the mail saying you're getting audited, what's the first thing you do as a high-level entrepreneur?
You call.
Welcome back to another podcast. And Karlton Dennis, I appreciate you being here, brother.
Thank you so much for having me on, man. I'm stoked to be here.
It's going to be a ton of fun, man. You've been on a podcast tour.
Yeah, I've been roaming around Arizona right now, just podcast to podcast. And it's pretty hot here, man. I will say it, but I've been dropping some heat on these different shows.
You brought it, dude. You brought the heat. You know what I mean? So I want to dive right into it and just give a ton of value. And where I want to start is the tax system in America, right?
Yeah.
And talk about, so many people think that the tax system is rigged against them, right?
Mm-hmm.
And that they're paying property taxes and they pay sales tax and they pay this tax and that tax and they think they can never get ahead. What do you have to say to that?
Yeah, there's a tax system for the educated and the uneducated, and it's working perfectly right now. Those that are educated are able to take advantage of what the government wants them to do, and those that are uneducated sit and complain and wonder, why am I constantly being penalized? At the end of the day, you're going to have to get yourself educated over what the government wants you to do and start formulating strategies that can draw down your taxable income and also build up your assets at the same time.
How do people not learn that?
Because taxes aren't taught in school, man. It's like the one thing that they just decided, we're not going to teach this. But it makes so much sense because they do teach you in school to work to get a job. And then when you do get a job, you pay the highest taxes. They don't teach us to become professional investors where we're subject to capital gains taxes at more favorable rates. School teaches us to become employees where we're going to be taxed at the highest rates. So this is part of the reason.
And is it just something that entrepreneurs have to learn? Like, when let's say you're an entrepreneur, talking to those people right now, and they start a business. I mean, do they just have to trial and error their way through it?
What sucks about starting a business is there's like no roadmap around how to handle taxes. So then you go to a CPA to try to figure things out. Most business owners wait, though, to go to a CPA because they'll go make money first and prove that they have a business model. And then they'll go to their CPA and find out, oh, snap, I've been doing everything wrong. I'm supposed to have a separate bank account. It might make sense for me to have an LLC. And I was my own bookkeeper and I don't even know what bookkeeping is.
Yeah.
This is where it all starts and why most businesses sometimes fail. It's not really the business model. Sometimes it's just the way you're running the business.
Totally. Yeah, the operating system, your P&Ls, you're not tracking your stuff, right? You got money coming from every angle and you don't know what the hell you're doing.
Yeah, because people start commingling and they start spending the money that's inside of their personal account, but that's where the business income is coming in too. So by the time they get to taxes, they have to go into that same personal checking account, DV up what was business, what was personal, what can I write off, what can I write off, and do I even have enough money to be able to cover my tax bill? This year over year starts to put a taxpayer into a very bad position. Now you're on the hook with the IRS, you're on payment plans. This is you being a business owner your first couple of years, you're on the hook with the IRS. That's not how you're supposed to be running a business. But many business owners start out like this because they have poor finances and they don't slow down long enough to get it right.
Interesting. Yeah. So let's talk about, the employee versus the 1099, right? Yeah. The entrepreneur, let's say. What do employees, what can an employee do? Can W-2 people do anything to save money, to put money back in their pocket, to be smart other than a Roth IRA or 401k or something like that?
Yes, this is what I need W-2 employees to understand. You may have maxed out your deductions, your 401k, but have you maxed out your investments yet? Most W-2 employees get so upset because they're not business owners, they can't take write-offs like cell phone, car, all of that. But you can take active deductions against your active W-2 income if you're investing in active businesses. An active business is like a working interest in oil and gas or investing into a short-term rental where the property is only being rented out for 7 days or less. These are ways in which my W-2 employees are able to offset 100% of their W-2 income. Now we have a decision, Austin. Do we really want to wait for Uncle Sam to just give us our money back in the form of a refund when we file our taxes in April? Or can we go back to our employers and adjust our withholdings and take home more money money, knowing that we're investing it into vehicles that are offsetting our tax bill. This is what I preach.
Yeah, totally. Yeah. So employees can do something about it, right? They don't just
Yes.
have to sit on the sideline and complain.
This is what I tell them all the time. If you're working with a tax professional, not just a tax accountant, your tax professional is supposed to be forward thinking. Most tax accountants are looking at historical data and inputting it into a tax software for the previous year. Most tax professionals or tax strategists are thinking about forward strategies for you in the current year and the future year. So that way you can get to tax season knowing already that you saved money and not getting surprised when your CPA tells you what that number is.
Sure. And you're a tax professional.
That's correct. I'm a
Okay.
tax professional. I'm not a tax accountant.
Not a CPA.
I'm
right?
not a CPA. I'm an enrolled agent.
An enrolled agent, which there's some type of school or test or something you have to go through to achieve that, right? It's a fairly high standard of whatever that is.
Yeah, so CPAs get their bachelor's degree typically in accounting, and then they'll sit for 4 tests, which it revolves a lot around accounting and 1 part tax. An enrolled agent studies predominantly tax. So we study individual tax, business tax, and ethics. So we are very equipped to represent people in front of the IRS. We're very equipped to come up with solutions when it comes to how to mitigate your tax bill, and we can also file the tax return as well.
Got it. And when should somebody talk to somebody like you, right? Like, is there a threshold of income where it makes sense to talk to a guy like you, and a threshold where it's like, dude, you probably should just go make more money?
Yeah. For tax strategy, it really starts when you start having an income problem. What I mean by that is most people have not really had a big enough tax bill yet before they want to start focusing on taxes. You need to get to an income problem first before you start focusing on tax strategy. That's right around $300,000 that I'll tell people. Now you have a little bit of an income problem where you're making some successful money. You're paying about $60,000 in federal taxes off of a $300,000 salary or $300,000 in business profit. Coming out of college, I made $60,000 a year.
Yeah.
So that's someone's working salary for an entire year. By this point, you should start putting your emphasis on how do I mitigate my tax bill? Because $60,000 in my pocket, invested over the next couple of years in the S&P 500, that can grow to multiple 6 figures. And this is how somebody has to start thinking once they've solved the income problem.
Right.
But if you're only at $100,000 and you're paying barely $10,000, $15,000 in taxes, you don't have a tax problem. You have an income problem right now. I need you to go focus on solving that problem, then come back to me and we'll figure out how to offset the tax bill.
So in the meantime, do they just write the check with a smile on their face? Like when they're at $150K a year and they're paying 15, 20K, whatever you just said, right? Do they just suck it up and just go put all their energy into making more money?
You should be putting all your energy, if you're at 100 or 150K, into making more money, and you should be okay with paying taxes. I want you to pay more taxes if you're making 100 or 150K. Why am I saying that? Because you need to sacrifice. You need to have a Roth 401K, not a traditional 401K. You're not reducing your tax bill yet. You're not making enough money to be focused on reducing your tax bill. You need to have a Roth IRA if you're still in a point where you can qualify to make a Roth contribution. And if you're not, I want you to make a traditional IRA contribution, and then I want you to backdoor it.
Got it.
This is what somebody should be doing in those earlier years where they're just getting into the 6 figures. As you start approaching multiple 6 figures, now we can start flipping the table around and seeing, does it make sense to continue sacrificing and parking a lot of that money into the Roth account, just increasing your taxes? Or should we start flipping into a traditional 401K and different types of retirement vehicles to draw down your tax bill now?
Sure. So they come talk to you roughly around $300K a year or more, right?
Yes.
Is a guy like you or you.
Yeah.
And then go obviously on your website and do that. And before that, they just need a good CPA.
Yeah, absolutely. You just need a good CPA that can file the returns, do the bookkeeping and accounting, and make sure everything gets done on time.
Okay.
And then right around 300K is where you start to question, okay, well, does my CPA have the skill set of both a tax professional and a tax accountant? Because that's very rare.
Yeah.
It's very rare to find a CPA.
Have you seen it out there? Does it
Oh,
exist?
yes. I have a couple of friends in the industry. Matt Bontrager, for example, with True Books.
Great guy.
Yes, great guy. There's a few CPAs that have, Ryan Bakey as well, few CPAs that have completely adopted what it means to be a tax advisor. So they can turn off the CPA hat for a bit and actually step into what it means to project income and to plan strategies for a client. You have to think about it. Those are two different worlds somebody is living in, where I'm thinking through last year and inputting data into a tax software versus projecting for this year and then coming up with strategies.
Right.
That's a big ask on a CPA,
That's hard to do.
which is why I only focus on just being a tax professional, and I hire CPAs to just do tax accounting and tax prep.
For the guy who's making 150, 200, right? Whatever, maybe even 100. What are they looking for in a good CPA? Because Karlton, I mean, I've been an entrepreneur pretty much all my adult life, right? And I've had a lot of really bad CPAs. Like I've had CPAs where like mid-year, I'm like, you're fired. Like I can't do that. Like I don't want to change right now because I'm going to hate my life. And now I got to take those 6 months and go like, but I have to, right? Because they're just so bad at their job. They don't communicate. They never get back to you. They don't reply to your emails. Like what should somebody be looking for in that role?
The best CPAs have a great team because they need to be available to communicate with the clients. During tax season, what people think is that my CPA is so great. He must be so great because I never hear from him. He's always so busy. I send him an email. He responds 3 weeks later. That's not a good CPA. That's an extremely busy CPA or a solopreneur CPA. What you want is a CPA that has a really good team so that CPA can become available for you to update you on different changes that need to be made on the tax return before it's finalized, or be able to sit down with you and really take his or her time to review that return with you, to explain things before you hit the submit button. And so that's why I make sure my CPAs are extremely available to be able to have conversations with clients versus having all my CPAs just solely focused on filing tax returns. I need to have a team that files the returns, and I need to have people that just get on the phone with people and explain the tax returns and can be available to answer questions. That's important.
What about bookkeeping? Who's doing bookkeeping sub 300K a year? Like, should your CPA be keeping your books if you're making 150 grand a year? Or should you go ahead and go get one of these apps that we see, like Mint or whatever the case is, and try to do your own bookkeeping and then give it to your CPA?
100K or less, you could do your own books. Above 100K, no reason why you should be doing that skill anymore. You're at a point now where that skill should be 100% outsourced. You're going to be paying maybe $150 to $500 a month, depending on how many transactions you're having inside of your business a month. It's absolutely worth it once you cross the 6-figure mark to have a bookkeeper. And sure, can the bookkeeper also be your CPA? Absolutely. But I would argue that most CPAs probably have bookkeepers on their team to do the accounting and they just review the work, because that is such a much lower level job for the CPA relative to their degree.
Sure. Yeah, totally. I mean, bookkeeping, because what do you have to be a bookkeeper, like in terms of an accolade?
You do not have to have any type of tax accounting license. You can do bookkeeping with a basic couple of hours of training. And you don't have to have any type of license to do bookkeeping.
Sub 100K a year. Is there an app that you've seen over the years that you like for the guy who's making 80 grand? He's eventually going to make 800 because he's got huge goals. How should he be doing his own books right now? Is there an app?
I like Mint and QuickBooks.
Cool.
Mint is cool because it's the newer app. It's a little bit more intuitive. I like the user interface, but I'm a tried and true guy because I've been doing tax for so long, and QuickBooks is just that, source. It's kind of like the Bible in the tax and accounting space almost. And I love QuickBooks because it has a mobile version, it has a desktop version. You can take photos of your receipts and it syncs it up to the transaction. It just makes things so much easier. And 99% of all business owners are pretty much on QuickBooks.
Yeah, totally. The employee, okay, going back to that for just a second, should an employee who starts to get to a higher income threshold think about starting a business? Or at what point are they thinking like, man, maybe I should open an LLC? Like I have this Porsche, I can't write anything off. I'm just an employee, I'm a doctor, whatever the case may be, right? Like what do these types of people do?
They absolutely should consider starting a business or having the right type of investments that gives them a business on the tax returns. Austin, you and I love real estate. And the reason why I love real estate is because the IRS views real estate as a business and an investment. So if somebody at that high income, $500,000 a year, is not focused on trying to get some type of active business on the tax returns that can generate an active loss on the tax returns, they're literally just giving 40% of their money every single year to Uncle Sam. They're saying, I'm going to work January, February, March, and April and parts of May, and just say the first 4.5 months are cooked. That's just the IRS's money. Yeah. Then I'll start earning money from June until the end of the year. Like, come on, man. Is that what being successful is supposed to be like? The more money you make, the more that just goes to Uncle Sam? You decided to go to school longer and become a surgeon instead of just being a nurse, and now all of a sudden you have to work 4.5 months for the government to give them taxes? That's not how the system's supposed to be set up. But people get stuck because they refuse to look outside of their accountants. They go to their accountants for the same thing over and over again. Well, what can we do? What can we do? The accountant's going to tell you the same thing. Make your estimated tax payments. Here's where we file the returns, because they're looking at historical data. They're not trained to be forward thinking. And this is the issue I see.
It's a huge issue. I mean, when you really look at the world as a whole, the U.S. as a whole, right? The amount of people that are uneducated and going to other uneducated people to get advice on what to do, that literally changes the trajectory of their family's future forever. Like if they save hundreds of thousands of dollars and invest, like we're talking about millions of dollars over the course of time.
You're absolutely right. And we do these scenarios all the time for people where we show them, hey, just by doing this one tax plan, you're going to save $140,000 this year. And like, their eyes will widen.
Yeah.
But what we then do is we show them, hey, let's park this into our calculator. If you just put this into the S&P 500 over the next 10 years, that 140,000 actually is turning to 840,000. And then their eyes just go whoosh, because they start to really understand compounding of savings more than just getting a quick savings that year. And that's what I really want people to get attached to. You're compounding the tax savings in your investments year over year if you're making the right decisions.
So what do you say to the haters out there who may be lower to middle income that, you know, they look at guys like Donald Trump or Elon Musk or Jeff Bezos or the wealthy, right? And they're like, wealthy don't pay taxes, but they don't, you know, contribute their fair share. Like, you see these types of people in the world, right? Like, what do you say to that person?
That's poor middle class behavior. You'll stay in the poor and middle class if you constantly have that attitude. Why them? Why not me? This system is so unfair. I just can't even be around people that act like that, brother, just because I have such a positive attitude and mindset on life. I am naturally curious. People who find success are naturally curious. They don't sit there and question, well, he must be doing something illegal. They sit there and think, how did he do it? How did he figure out? What's the strategy? What's the play? They think intuitively. And this is why I think your environment is so important, right? Who you hang out with leads to your habits and how you excel in life. And I think of a lot of people that are finding a lot of success right now is because they've associated themselves with people who have the right mindset and the right attitude.
Would you say it's the number one thing to become successful is a law of association?
I wouldn't say it's the number one thing, but I would say it's definitely up there.
Top three.
Yeah, environment is environment shapes your outcomes.
I agree with that completely.
Your environment shapes your outcomes.
Who, not how.
Who, not how.
You know, at the end of the day, dude, I built everything that I built as a result of my network.
Yep, absolutely.
100% of the time.
That's probably arguably one of the best books I think I've ever read was Who, Not How by Dan Sullivan, I believe, right? And I found my who about 4 years ago, which absolutely allowed for me to just go kick ass on the internet. I wasn't able to do all this internet stuff and be on YouTube because Karlton had to turn around and do the fulfillment. I was the one building the tax plans, getting on the calls and explaining the tax plans until I found my who. And then my who was like, no, I'm going to do this. I'm going to also build out the team. And it allowed for me to go step into this rock star role. And
how did you find that who?
God, to be honest with you, I'm a big believer in manifesting and speaking to God on what you want. And I was living in my apartment complex and it was during COVID and I ran into this guy who I had met previously in my apartment complex and I knew he had a little bit of a disgruntlement with his employer and he was in a sales job. And I said, listen, come sell for me, man. And, you know, I did kind of the movie, what's the movie where he shows him the paycheck?
Wolf of Wall Street.
I did the Wolf. I did the entire.
You show me a pay stub. You make 73,000.
I did the
quit my job.
exact Wolf of Wall Street thing. His name is Kyle. His name is Kyle, and he's the president of my company right now. I pulled up in a black Porsche to our apartment complex. Kyle was like, "Whoa, did you just get that?" And I was like, "Yes, I did." And he's like, "Remind me what you do again." I was like, "I told you, bro. I'm doing tax strategy. I'm a tax strategist, and I need to build my team." And I was like, "Do you want to go talk about it?" And we talked about it later that night by the barbecue pits up top or the fire pits up top. And I literally showed him how much money I was making in commission right then and there. And I was like, listen, I'm going to give you these books to go read. If you get these books read in 2 weeks, we'll hop on a call. I'll test your knowledge. And then you put in your 2 weeks with your employer and I'm going to teach you how to build this.
And he called you in 2 weeks?
2 weeks, had the books read. He read Tax-Free Wealth by Tom Rilbright. He read Rich Dad, Poor Dad by Robert Kiyosaki. He read the 10X Rule by Grant Cardone. He had that stuff read.
Wow.
His mind was sharpened. And when we got on the call, he was like, I get it. I get what tax is. I get what the advantage of it is. I get why I need to grow my income. I understand why I need to be in control of things. And how do we get started on working together? I went and drew out the plan. 2 weeks later, he put in his 2 weeks with his employer. He was working for me, and we started scaling to the moon.
Wow. And that was 4 or 5 years ago.
That was actually, you know what? That was 4.5 years ago.
Wow.
Yeah, 4.5 years ago.
And were you still doing stuff with your mom? Because I knew you were.
Okay. Yep. I brought him into my mother's company, and then we eventually grew Tax Alchemy together.
That's super cool.
Yep.
Yeah. I want to go back to the employee really quick because you said something that stuck in my brain that I wanted to follow up on was, you know, when we were talking about a W-2, high income W-2, switching over and starting a business to be able to do stuff, right?
Yes. Well, they don't have to switch, but they need to have a business on the tax returns.
What if it loses money every year though?
Well, we want it to lose money while it's still cash flows. It depends on what the asset is.
Got it.
Right? Because if I'm investing into a short-term rental, or even if my wife qualifies as a real estate professional, which we can talk about what these descriptions means, I can do a strategy called a cost segregation study where I can accelerate depreciation. So it creates a paper loss on the tax returns, even though I might be collecting rents that cover my mortgage and I'm cash flow positive. This is the game that the rich play. This is called the rental loss game. If I have enough rental losses on the tax return that can offset my active forms of income, I don't pay any taxes. And the only way I'm going to be able to get those rental losses is if I accelerate depreciation. And the cost segregation study is that strategy. So if I'm a high net W-2 or if I'm a self-employed business owner making $500,000 a year, I can invest money into a short-term rental and do a cost segregation study and accelerate depreciation and capture a paper loss that can offset my active forms of income if I'm materially participating, if the property is being rented out 7 days or less.
Right. Talk to me about that. The real estate professional, 7 days or less. Let's go into let's dive in.
I love this. So part of the reason why I spend a lot of time talking about real estate professional status is because the IRS has created rules that prevents you from being able to use passive losses to offset active forms of income. Back in 1986, we had the Tax Reform Act. With the Tax Reform Act, that essentially separated passive income from non-passive income. Before that, it was all income. So if you invested in real estate, it was not considered passive. It was just considered income. If you had a W-2 job, it was just considered income. After 1986, we defined what was passive and what was not passive. And the government said, when you own rental real estate and someone else is paying your mortgage for you, by nature, it's a passive business. And the deductions that you receive passively should not flow over to offset your active forms of income unless you're making under a certain amount of income, like $150,000. So for many people before 1986, you could invest in real estate and offset your W-2 1099 taxes, which is great. After 1986, you're not using those deductions anymore to offset your W-2 or your 1099 income. But in the same tax code, they wrote what is a real estate professional. If you can show the IRS that you're spending 750 hours managing your rental property or in a rental property trader business like flipping, wholesaling, being a real estate agent, and you spend more time in that real estate operation than any other job that you have, whether it's a W-2 job or another business, you qualify for this status called real estate professional status. Now the IRS views you as active over your real estate portfolio. If you have deductions like cost segregation studies or accelerated depreciation, those losses are active losses that can flow over to offset active W-2 income on the tax return, active self-employed income from an LLC or an S corporation. So when I saw this, I was like, wow. For many taxpayers who are single, they're not going to qualify as real estate professionals unless they're in the real estate space because they have W-2 jobs. They're working 40 hours a week. Unless they're spending 41 hours a week in real estate, that's not going to work for them.
Right.
I can't justify that on a phone call with somebody for a tax strategy. So this is why spouses work out really well when you have high income. Because if you and your spouse are pulling in 500, 600, 700K a year, y'all are getting crushed in taxes. One of you guys probably needs to become the real estate professional. One of you guys needs to continue to make the $500,000 a year. The person that becomes the real estate professional is able to be the active participant on the tax returns. And that's how we're able to do the cost segregation studies. But what happens when you're in a situation where both husband and spouse both want to work, or you're single and you want to invest in real estate and you find out about this real estate professional status and you know you do not qualify? Is there a way around this whole passive activity loss rules or this real estate professional status? And this is where I got curious back in 2020. In 2020, we had COVID. I had time. I went back into the tax code. And in that same tax code, IRC 469, the IRS defined that a short-term rental falls out of definition for tax purposes as a rental real estate activity. Okay, well, what was a short-term rental back in 1986? Because they didn't have Airbnb,
Right.
And they didn't have a VRBO. So what could be a place that somebody could
Hotels.
go? There you go.
Right.
Hotel and motel businesses.
Yeah.
Okay, so then what makes a hotel or a motel different than a normal investment
People are
property?
staying in a shorter time frame.
People are staying in short times, but define what shorter means. And it's in the tax code. Transient basis means 7 days or less. Interesting. The average hotel has guests that stay 3 to 4 days.
Yeah.
So if you're running an Airbnb business, a hotel motel like business on a transient basis, You have an active business in the eyes of the IRS. You don't have to qualify as a real estate professional. You don't have to spend 750 hours. You don't have to spend all your time in real estate. You just now need to spend 100 hours materially participating or managing that short-term rental, and more time than any other person. So if you hire someone to help you, like a handyman or a cleaning lady, spend more time than that person, and now you have an active business. This is where we start to do the cost segregation studies for these taxpayers now.
So cool. You know, like, I mean, the amount of people that don't know about that.
Yeah.
It's pretty wild.
And I wanted to explain it in a way that hopefully it can make sense, bringing it all the way back to the history, because in order to build real wealth, you have to understand history. You can't skip it.
I completely agree. And that really is the benefit when we're talking about the real estate professional, and we're talking about high income earners, and we're talking about the difference between a long-term rental and a short-term rental.
Yes.
That's the benefit.
Absolutely it is. That's the benefit.
Like, no question about it.
Yep. If you're going into long-term rentals, you better be trying to qualify as a real estate professional, or everything's going to be passive for you.
Or your spouse.
Or your spouses. If you're not, then I would highly recommend you look at the short-term rental. Now, here's where I'll bridge in one other strategy in the real estate space that's typically reserved for self-employed business owners. Okay. Let's just say that you wanted to have a new facility, and maybe it was going to be a content facility, or maybe it was going to be any type of facility. You're a physician and you just want to have your own practice. Instead of leasing a space and paying rent, you want to buy the building. Is there a way in which I can do some of the same strategies that I'm talking about with real estate professional status or short-term rental if you were to go buy a building? And there is. It's called the self-rental strategy. If you have 100% ownership of your corporation and you have 100% ownership and interest in an LLC that owns a commercial building, you can make a grouping election to group a property with your active S corporation business. You could perform a cost segregation study on that building, accelerate depreciation, and flow through and offset some of that K1 income that comes over from your S corporation. This is how I'm able to help self-employed individuals who don't have time to run a short-term rental business or qualify their spouses as real estate professionals, and this is called the self-rental strategy.
Now, does that just work for 1 year, though? What are you doing year 2, 3, 4, 5?
So when you accelerate, I'm glad you asked that question, and I hope someone's thinking like this. When I accelerate depreciation, Karlton, well, what happens in year 2, 3, 4, and 5? You're not accelerating everything. When you do a cost segregation study, you're essentially telling the IRS, I'm going to perform a study on my property to get the cost of all the structural components and the non-structural components. The structural components are what you think of, the load-bearing walls. If you've ever driven through a town that's just being developed, you'll see the steel, the wood, and the load-bearing walls. That's structural components. The IRS says, Karlton, unfortunately, you can't accelerate depreciation on that.
27 and a half years.
It's 27 and a half years, or 39 years for commercial. Sorry, buddy. And then on the non-structural components, which is pretty much everything else.
Define that. Give me an example of a non-structural.
Furniture, windows, appliances, even fencing.
Like lighting?
Lighting, light fixtures, custom cabinetry, doors, all of this counts as non-structural components. The nuts, the bolts, the screws, all of it. You can write this off in as quickly as 1 year with 100% bonus depreciation now, thanks to Mr. Trump and the big, beautiful bill. So essentially, when you're doing a cost segregation study now in 2025, now that we have 100% bonus depreciation back, you're getting around 25% of the purchase price as a year one tax deduction. Imagine if you spent money on $1 million property and I told you you're going to put $200,000 down, you're going to get $250,000 down in a write-off. What would you think? You would think, well, isn't it feel like the IRS is paying me almost to invest in this property? And that's exactly how you should think, because the tax code now is incentivizing you to invest in real estate. Now your down payment is netting you more in tax deductions because of the tax code right now.
It's amazing. On that subject, really quick, talking to the general public, right? Because you just described what I like to think of as obviously capitalism, right? Which is like, why did the government, once upon a time, the IRS, the government, Ronald Reagan, whoever, who decided, in the U.S. that, hey, we're going to incentivize entrepreneurs and business owners to go create opportunity in the United States? And obviously, these people have to hire employees. And, and the whole system works like that, right? Like, where did that come from? Has it always been that way? And why do you like that?
I think what it is that when we look at the way our tax system was founded, it was originally set up where we didn't have taxes. We were just taxing off of tobacco and alcohol. So we just had excise taxes, and they're extremely low. And then we got into World War I, and then we said, you know what? We are going to start taking taxes out of people's paychecks temporarily.
Sure.
But who were the people that decided this was going to happen, right? Was it these large oil companies? Was it these people that came together and said, we need to formulate a system in which we start taking taxes out to be able to fund the war and to keep oil going into our ships, oil going into our vehicles, whatever it is that they need this oil and power for. So I think it was big powers at play that were pulling together the tax system, because after the World War, they then turned around and made it permanent. Rather than it being temporary for us to have taxes taken out of paychecks, this became a permanent law. And then over time, what you started to see is incentives started to be placed into the tax code. Invest in oil and gas, you receive a tax credit. Invest in the solar, you receive a tax credit. Real estate, you start to receive depreciation. Why?
Right.
Because the government can't provide all of this to the United States. They can't provide affordable housing for everybody. They can't provide oil and gas for free to everybody. They can't provide renewable energy to everybody. So what we're going to do is we're going to get all these big business owners, all these Elon Musk brainiacs to go do all of it for us. And we're going to create subsidies and tax incentives directly for them because they're helping everybody. And we understand that. We cannot do it without them. So we are going to create tax incentives for large business owners and investors because we realize we would be shit without them. That's the truth, brother.
And that's amazing, right?
Yes.
And that actually goes all the way back to the very beginning. When I said, when we were talking about that employee with the bad mindset, right?
Yes.
They need to understand that they're working for the guy that you just talked about, right?
Yes.
They're an employee to the guy that took all the risk, that's doing all the stuff, that's paying all the property tax, all the employee tax, all the everything. And they don't have to worry. Their paycheck comes no matter what. They get sick, they get COVID, they get paid.
Whether you decide to work your ass off or you decide to be a degenerate showing up to work, you get the same paycheck, bro.
So why should you have all these incentives?
Why should you have more tax incentives than the business owner? That makes no sense. Why should you be pissed off at big business owners who created the cell phone that you talk on and the laptop that you get to type on? Like it makes no sense when you step back and look at it 30,000 feet in the air. It's honestly extremely selfish for them to think like that.
Yeah.
If you're an employee and you're thinking, oh my gosh, these big business owners and big billionaires should be taxed, you're thinking selfishly. You should be thinking, how can I do more to be able to help myself by learning from them? So it's just a difference in mindset shift.
I want to go back to short-term really quick, and then I want to go to the big, beautiful bill. On the short-term rental, you said 100 hours.
Yes.
You have to work more than your handyman, your painter, this, that, and the other thing.
Yes, absolutely.
How does one document that?
Yeah. So what I like to do is I like to give people a real estate tracker where it shows the date, the time, and the activity of everything that you are doing in chronological order. Part of the reason why this is so important is because documentation is what the IRS needs in an audit in order to validate that you did qualify as a real estate professional or you're running a short-term rental. It's not just about the fact that you had Airbnb bookings and cash to show for it. It's really about the time that you put into place. And one of the ways in which they can really be pretty stringent in an audit against you is matching up the dates on your tracker or whichever tracking system you have to your transactions in your business bank accounts or your checking accounts. So let's just say, for example, that I have a property here in Arizona, but I live in Florida, and I'm saying that I'm managing that property for 100 hours and I'm traveling to it, but then my transactions on the dates that I have in my tracker show that I'm in Florida, but I'm supposed to be in Arizona that day having, real estate professional hours. So this is one way a lot of people can get caught up by trying to recreate these tracking systems later when they're in an audit, which is why I always recommend to track things in real time. Most IRS audits happen 3 years later. So people who are getting audited right now in 2025 might be getting audited for a tax year in 2022 or 2023.
Wow. Is there any apps or software? Is there anything that make that easier? I know there's a driving log or an app in your phone where it'll detect when you're driving your vehicle and it'll automatically log it.
Yes, there's an app called Reps Tracker. That's the one that we recommend to clients. It's an app that you can download to your iPhone and you can input your property addresses into it and immediately start tracking your hours, whether it's an STR and LTR. Makes it super easy.
What qualifies for that 100 hours and what would not qualify? What could you say, hey, I was doing this, and the IRS would be like, no, that's not one of the 100 hours.
Yeah, so the IRS does not allow for you to count investor-related time when qualifying for a short-term rental strategy or real real estate professional status. So if you're just sitting at the computer doing education, researching properties, education and research time do not count in as material participation. You're not impacting the day-to-day operations of that property or making the property go as the IRS would define it. So simply just sitting behind a computer on Zillow or Redfin is not going to cut
Looking at deals.
Looking at deals, all surfing deals. Even overly spending time on your financials. I spent 3.5 hours just, moving things around in my QuickBooks.
Looking at the P&L.
It's like, okay, come on. If this is how you're trying to get to your hours and this becomes a big part of the substance of how you're maintaining your hours, the IRS could disallow it.
Got it. Okay.
Yes.
Yeah. But ultimately, it's really simple to just follow and do it the right way. Get that app and just track it. Do things that actually move the needle.
Yes.
Like it's not hard.
No, escrow process is a part of your hours, sending data, going to and from the property, inspections, furniture, all of that. By the time the property's up and rolling, most of my clients have already put in 25 to 38 hours.
So random question, and this might be more of a question for a guy like me, but I want to hear your opinion on it, right?
Yes.
On the Airbnb stuff, you're coming at it from the angle of taxes and saving money, right? So let's say you tell somebody they're in a situation, you're doing tax strategy, right? Like we're like, look, we need to get you an Airbnb or 10 Airbnbs or whatever, right? Now, I live in the real estate world. I know that in Scottsdale, Airbnbs are fire selling right now.
Yep.
And everybody overpaid for them during COVID, and there's a lot of Airbnbs where people are losing their ass. Now, it doesn't mean all Airbnbs people are losing their ass, but there's a lot of them, right?
Yes.
At what point does it matter? Like if you're saving enough money on the tax side,
yes,
and you go get an Airbnb over here that breaks even. Let's say it pays your PITI, but you're not making any money, but you're saving. Like, where do you try to get people into an Airbnb into like a Nashville or a Scottsdale or somewhere where they're genuinely going to make more money?
Yes.
Or is it just solely like, hey, anything above break even's in the green? Like we're good.
I always recommend to clients, like we're starting a business, which means the business needs to be profitable. Regardless of taxes, we're not getting in this to just save money on taxes. We're getting in this to build wealth.
We want to do both.
We want to do both.
Right.
Now, it's not to say that some of my clients are, knuckleheads and they invest money into places that don't make sense because, they just want to have a house up the street from or house down the street from them. But most of the time we're partnering with the best short-term real estate specialists and they're going to the Smoky Mountains. They're going to 30A. They're going to Destin and parts of Fort Lauderdale and getting the houses that are, within a mile from the beach or in the friendly kid zone. And most importantly, they have a plan in place. If you're going to go into an Airbnb and do the real estate play, that's great. But how about running that business long term? What type of plan can we have in place before you even acquire the asset where we know by putting an extra $150,000, $250,000 to build in a wave pool or to build in the pickleball court into the backyard, that it's going to be able to give you that cash flow that you're looking for based off of, relative performance.
Yeah.
So this part of it is where we kind of have to slow down a little bit before we get to go fast.
I like that.
And I like slowing down with clients because the tax savings is what gets them through the door. Like, okay, shoot, this is going to be so sick. And then they realize, oh, I'm running a business here. And I get them to slow down and realize this. And that's so important because any tax advisor can come on here and say, dude, 7 days or less, 100 hours, go do it. Airbnb, short-term rental, go do it. But I'm a tax advisor that wants my clients to stick with me for a long time, and I want to build wealth with my clients. So if I just let my clients just go rush out there and buy any old deal just to get the tax savings so Karlton can say, oh, we got another win here, and then they're not able to reinvest with me in the following year back into tax planning because Karlton Dennis isn't cheap. And then they don't want to get into another investment property because their one deal is just sitting vacant and now they're covering their mortgages half of the time. That does not leave a good feeling to the customer, even though they may have experienced those tax savings with you in that 1 year. This is a marathon, not a race when it comes to tax planning. And most people sometimes want to drop a Band-Aid solution on it. And that's not what we're trying to do. I'm trying to perform the surgery so I can make you run faster forever.
Totally. Yeah, I couldn't agree more. Let's talk about the big, beautiful bill. Donald Trump, big, beautiful bill. A lot of mixed opinions about the big, beautiful bill, right?
Yeah,
What's your thought?
I mean, a lot of great things and some things that got taken out. One of the things that I would say that bothered me a little bit about the big, beautiful bill, because most people know that I'm pretty conservative. I'd say what bothered me was removing the renewable energy. But here's the thing. I have a daughter now and I care about protection. I care about knowing that when I go to a grocery store, my wife goes to a grocery store and I'm not with her, that someone's not going to run up on her, or that we're just not going to be in an environment where illegal drugs and illegal aliens are coming into our country. Yeah, totally. That is actually something I care passionately about now, especially as a parent. So we took a lot of that funding that we had that was going towards renewable energy and just parked it over to the border wall and security. And And that's been working out really well. But a lot of people are pretty pissed off about that, including Elon. So that was one thing that I saw that was pretty interesting. Would love to hear your ideas on that.
Yeah. I mean, I think I agree with you. I think that there's, I mean, look, here's the one thing I'll say about Donald Trump, right? You love him or you hate him, it doesn't matter. He's one of the best deal makers, if not the best deal maker on planet Earth, right?
Correct.
And so I think sometimes, we're in our own world doing our own thing. And sure, we might be super successful, right? People might be watching making 10, 20 million bucks, but it doesn't even compare to the world that Donald Trump's living in, right?
Yep.
And the access to information that he has. And I mean, just the knowledge. I mean, we're talking Area 51, like crazy stuff, right?
Yes.
So it's like, who are we to sit here and judge every single little thing? It's like, at the end of the day, we choose a party that represents most of our ideals,
Correct.
right? Not all,
yes.
Most, right? It's like, you're either a Republican or you're a Democrat, and it doesn't mean you have to agree with everything they do and say.
Correct.
It means, hey, I agree with the majority of what they do and say, right?
That's right.
So that's kind of where I stand on the whole thing. It's like, when I voted for the person that I liked the most, right? And I think for the most part, he's doing a pretty good job, So it's like, there's aspects I don't like, right? There's things that he does. There's tweets that he tweets out, right?
Yes.
On True Social, where you're like, God dang, dude, like, you don't need to do that, right? Like, you're stirring the pot,
Yeah, he likes to pop off with those Twitter fingers sometimes.
But it's like, dude, there's a bigger plan at play, right? He's doing some sleight of hand. He's negotiating over here while he's distracting you.
Yes.
So you just kind of have to trust the process, I think, to a degree.
And those of us that said, you know what, we're just going to trust the process, we're sitting here like, dang, this is exactly what we voted for.
Yeah.
And then people that were like, well, I'm not sure what's going to happen, they're like, whoa, look at what's happening right now. So it's really cool to see that. One of the biggest things that came a part of the Big Beautiful Bill was this whole no taxes on tips that didn't really actually become reality. I thought we were going to get no taxes on tips, but what we landed on was being able to deduct up to $25,000 of tipped income on your tax returns, which is pretty awesome.
And it used to be zero.
It was going to be, the fact that we were going to have no taxes on tips entirely. That was Trump's big hoorah moment.
Sure.
And existing before the Big Beautiful Bill, we had total taxes on tips. You report all your tipped income. Now,
which nobody did.
Yeah, I would say most people.
Or a lot of people did.
A lot of tipped employees don't like reporting their tipped income unless their employer makes them report it. That being said, you're now able to deduct up to $25,000 of tipped income. So yes, you want to report it because you get to deduct it against your ordinary income up to $25,000. But the issue is that it phases out over $150,000 adjusted gross income. So sorry, high income earners, this one's not for you.
Yeah, but how many high income earners are working in a job where they're getting tips?
Yeah, that's true. It's really for the people that are in that field where they're in hospitality.
Because I can't really think of much, right, where you'd be making $250,000 a year and getting a bunch of tips.
No, not at all.
It's like pretty rare, I feel like.
Yeah, you have to be a rare chef.
What about literally. what about bonus depreciation? Talk to me about that in the Big Beautiful Bill, because we used to have that, right? And then we started going down like 80, 60, 40. Yeah. So where's it at now?
Yeah, the Big Beautiful Bill brought bonus depreciation back to 100%. Okay. Thank you, Jesus.
Literally.
This is going to be amazing for the United States.
And it's for good?
It's for good. We don't have to play games anymore with it's on the sliding scale. It's permanent. People can now buy vehicles or buy equipment or buy real estate and depreciate it entirely in the first year.
Wow.
This is absolutely amazing because what you get to do now is you have to spend less money to get more in tax savings. You can go leverage other people's money and put a down payment down on a vehicle or put a down payment down on investment property and be able to depreciate more on your tax returns, keeping more of your hard-earned money in your pocket. Yeah. This increases people's investing power. And that's what I love about the 100% bonus depreciation. So if you're listening to this right now, what I want you to know is if that Big Beautiful Bill didn't get passed, you would have only been able to receive 40% bonus depreciation on a qualifying piece of equipment or vehicle that you placed in your business this year. That just went to 100%. So to do simple math, let's just say we bought an F-150 that weighed over 6,000 pounds that we use 100% for business. And we go to the bank and we finance $95,000 and I put down a $5,000 down payment. Okay. And let's just say I'm in the 37% tax bracket. $100,000 times 37% is $37,000 in savings. With my $5,000 down payment, I'm essentially pocketing $32,000 by buying that F-150 and using 100% bonus depreciation and placing it inside of my business. This is a win for taxpayers because you just were able to use other people's money to arbitrage tax savings.
Now, when does that not work? Is there a situation you can think of where people try to do the bonus depreciation? And it's like, no, that's not what it is. Like, you know what I'm saying?
Yeah, there's times where people get into investments or make decisions that aren't smart that end up costing them in the long run. For example, they never did the math correctly. So you're putting down more than what you should on a property or a piece of equipment and leveraging bonus depreciation. And then you have payments on that piece of equipment in the following year. So it nets you at a loss, right? So if I'm having to pay $2,500 or $3,000 a month for that F-150, is that really helping me even though I got the tax savings that following year? Or is it just an asset that's depreciating over time that I now have as a liability that I have to pay $3,000 a month for? So this is why I like buying real estate, because at least somebody else is paying down the mortgage. Whereas when I buy vehicles or or things that aren't true assets, they are really just liabilities.
Okay. And it does have to weigh over 6,000 pounds for like the equipment side of it, right? For
Yeah.
the bonus depreciation.
For bonus depreciation on a vehicle, the vehicle needs to weigh over 6,000 pounds and under 14,000 pounds. For qualifying equipment, you can place any qualifying piece of equipment into your business and deduct it as a year one
So
write-off.
if you own a landscaping company, you can go buy a big backhoe.
Yes.
And that's fine.
Yes.
Obviously. But if you're a real estate guy and you buy a G-Wagon in your business and you drive your G-Wagon only to real estate showings, you can do that though too, correct?
That's 100% correct. And I would say the G-Wagon is probably one of the bigger, probably the one car I write off on tax returns the most by self-employed individuals. I would say the G63 and the G550, I write those cars off more than any other car in my firm.
And why is that?
It just seems like most entrepreneurs live between Texas, Arizona, LA, and Florida that I work with. And they all drive G-Wagons there. I would say probably last year, we probably wrote off at least 26 G-Wagons last year.
Wow.
So that was a lot that we did for Mercedes. I hope they know that.
Yeah. Mercedes, you need to watch this. It's only going to go up. Does a Urus weigh more than 6,000 pounds?
The Urus does have a gross vehicle weight ratio of above 6,000 pounds.
Interesting. I had a Urus. I didn't write it off that year. It was the year I didn't need I just bought it because I wanted to buy it. You know.
Oh, good. Well, then you don't have to pay recapture on it too when you sell it.
Yeah.
Which is something that most people don't understand either. It's like, okay, I bought this car, and then 2 years I want a new car. If you trade your car in, that's a sale technically. So you're going to recapture the depreciation you took on your tax returns as income. So just because you're able to use 100% bonus depreciation on a G-Wagon in 1 year, and then you go sell it for another car 2 years down the road, doesn't mean it was a smart tax play. You're going to recapture that depreciation that you took as income in the year that you file your tax returns.
How do you solve that? Like, do you just keep drive the car into the ground?
Well,
keep it forever.
If you're trying to solve it, you keep the car for the full depreciation life period, which is 5 years. After 5 years, the car's fully depreciated.
Got it.
Yeah.
Okay, so just keep the car.
Just keep
buy the car and keep the car.
Yeah. After 5 years,
and
depreciate.
Next year, if you want to buy another car, then just buy another car on top of the car you already have.
You could. Yeah.
I mean, if you
but
really
it would
wanted
need to make sense. Yeah. Absolutely.
Of course, but it has to then go back to the IRS. So then, is it? Can you do 2 or 3 or 4 or 5? I mean, probably not, right? At some point, the IRS is going to say, you don't drive 3 G-Wagons at the same time.
You know, there are clients of mine that have 10, 11 cars, but their business requires that. They're running drug rehab facility centers, and so they have different cars that pick up the patients and take them to and from the treatment facilities. So they're buying tons of Mercedes Sprinter vans. But then I might have a real estate agent that's like, okay, we have 2 cars. One we take all of our clients in. It's this Mercedes Sprinter van, and then this is my Ford F-150 or my Escalade. So I would say most entrepreneurs 1-2 cars max, unless you're running a business that requires a fleet type of operation, and that's where we start to see more vehicles.
Got it. Okay. What's the craziest thing somebody's ever tried to have you write off for them?
Well, we've written off a yacht before, and I would say the best write-off that I was able to do for somebody was helping them write off their jet. We were able to write off a Falcon. And that Falcon, I think, was like just over $6 million.
Wow.
And
wrote off the whole thing.
We wrote it off underneath 100% bonus depreciation through their through an LLC, and we leased it through their S corporation.
Wow. And how does that work exactly?
They purchased the vehicle through an LLC, so it's a vehicle.
Sure.
You normally, when you're buying jets, you have to put like 40% down payment down on jets. Something I learned. You're either going to go a jet card route, or you can be a fractional owner of a jet, which means multiple individuals all own that jet, or you're going to buy the jet outright and you could finance it. And typically, when you're coming to the table for financing, they want to see that you're coming with 40% down.
Interesting.
So my client came with 40% down. The jet was about, let's just say, $5.5 million. At the time that we took this write-off in 2023, bonus depreciation was at 80%, but for commercial aircrafts, they had a different sliding scale. So in 2023, they were still at 100% depreciation. All residential real estate and everybody else was at 80%. So we were able to claim 100% bonus depreciation that year. He purchased it through an LLC. We created a leasing agreement where he leases it to his S corporation. We updated his S corporation operating agreement, which states that there's a vehicle that's being operated on behalf of the corporation. All of this legality had to be done in order to make sure he was ironclad. And then he had to take delivery of it and go and take business trips.
Yeah.
He was on that plane for a good majority of December when he got it delivered to him, because he got it delivered later in the year in order for him to justify it being 100% business use. And then it also gets chartered a lot. So majority of the time it's being chartered. So unless he's up in the plane for him taking a business trip, it's chartered 100% of the time.
In your opinion, when does it make sense to buy a jet? Does it ever?
Yes, it does. Yes, it does, because I am now seeing how important it is as a business owner who has a family, how precious time is. And there becomes a point where a $2 or $5 million jet doesn't matter anymore. Getting home to your daughter or to your son does. Getting home to your wife does.
I like that.
And the reason why some of these entrepreneurs that are floating around 50 million net worth or above start spending money on jets or jet cards is not because that it's not just because the business that they're doing is so important that they have to get to that business destination. It's because their family is so important that they need to get their ass back home. That's what I see.
I like
and
that.
If you ask me, hell yeah, that's important.
Hell yeah.
Yeah.
50 million's the number?
I would say 50 million.
In your opinion?
In my mind, I'm telling myself I'm not buying a jet until I at least have a $50 million net worth.
Yeah, 50 million net worth. And then what, at that point, what would you justify? $3 to $5 million jet, probably on the lower end?
Oh, 100%. Yeah, I would say like
you're not buying a G550.
No, I would go somewhere around 10% of my net worth.
Okay.
So I would probably spend around $5 million on a jet.
I like it. Yeah.
Yeah.
Tell me about the yacht. I got to know about it.
Yeah, the yacht. We've written off actually a few yachts now. The yacht story really appeals to people because that was such a defining moment for my mom. My mom is really good at helping people win against the IRS. She wanted to become like a criminal lawyer. And she even tried to join the FBI. Like, she has such a dope background. And my mom, when she was growing her business, she got all these really challenging cases because most other CPAs or enrolled agents, when they couldn't figure out something, they would go to this like enrolled agent CPA hotline and like they would contact my mom. And so we would get these customers that would come in with these complex different issues. Well, this one woman came in and she was on $1 million listings and she had purchased a vehicle, and the vehicle was a yacht. She came into our office and she told us she had already visited with other CPAs. She had her tax returns with her. We opened up the returns. She owes $1.1 million to the IRS. It's on the front page of her taxes. We're like, dang.
Yeah.
At least I was. And my mom was just stone cold. My mom's like Neo in the Matrix. Nothing phases her. That being said, she went on to explain why she bought the yacht. She takes out celebrities, she takes out athletes, and it's all in California, in Newport Beach, Laguna Beach. She shows her clients how to buy real estate from the views of the ocean. She's not doing it from just pulling up and doing a normal listing. She does broker previews on the boat, and she had everything documented. Even her captain had a log booklet of everybody that came on, off the boat, chronological order with the date, time, and what the activity was.
Wow.
With that booklet that the captain had, the photos from her being on the boat, the transactions that she did that year, her P&Ls, we went into this audit in our office and brought the IRS down to our office for a field audit. We sat down in the IRS audit, and my mom did a majority of the talking, and this was a great learning experience for us. We were able to explain everything to the IRS auditor, her facts, her circumstances, her positioning as $1 million listings. She's a $1 million real estate agent. She lives in Orange County. She speaks on TV. Here's her image. And by the way, code section 162A is the most important tax code. It states that as a business owner, she could take business expenses that are ordinary to her, necessary to her, reasonable to her in the pursuit of income. And the IRS agent looked at my mom, looked at me and said, "It is so cool you guys get to work with clients that know Kobe Bryant and Shaquille O'Neal." Because she had photos with them on her boat. And brother, that was the day that I literally had no more fear of the IRS. I realized, bro, the IRS are no different than dentists. They're just there to point out things that you already know. If you're not flossing, you already know that your dentist is going to tell you that the moment you get underneath the dental chair. Are you flossing or not?
Right.
And you hate when they tell it to you, but you know you didn't do it.
Yep.
Or you skipped a dentist appointment. That's you just being a procrastinator over your taxes, which leads to you having mistakes on your tax returns. Or more importantly, bro, you don't brush your teeth twice a day, which means you're not being proactive. You're not being forward thinking. So you never end up getting the tax savings, and the IRS always wins on you.
Right.
This is why people fear the IRS, bro. They don't understand that the IRS is no different than a dental office, bro. They're just there to point out the cavities that you already know you have.
Yeah.
But if you're brushing your teeth twice a day, you're flossing, you're excited to go to the dentist. You know it's just a routine checkup. There's nothing to fear. Here are my receipts. Here are my bank statements. Here's my proof. Yes, I've been brushing twice a day. Yes, I've been flossing. And yes, I've been making sure that I've been getting all the way into the back.
Yeah, totally.
You feel, you know what I'm saying?
Dude, it's a great analogy.
So
right? If you do what you're supposed to do, it doesn't matter.
Doesn't matter.
It doesn't matter, bro.
Does not matter. And you shouldn't live in fear.
Right. But the people who live in fear, they either don't know what to do.
Yes.
Or they know what to do, but they're not doing it.
Yeah.
Right?
Yep.
And
or they've been told from other people, you should fear the IRS. Make sure you always pay that person. You never want to be on the hook with that person.
Right. It's crazy.
Yeah.
Do you think, is there a scenario where people should pay taxes? Like what scenario, like I'm talking about high net worth people.
Yeah.
Right. Or should they just try to just do as much tax strategy as they can and write as much stuff off as they can?
No. I think there becomes a point in time where you have to look at your risk tolerance because just simply trying to write things off may not improve your bottom line for an exit event that you're trying to have. Just writing things off may put you in a risky financial position because of the type of business that you're in. For example, if you're a restaurant owner and, all of a sudden we have a COVID 2026 situation happen, shoot, we were investing all this money to try to offset your taxes. Now you don't have liquidity to sit through another 11 to 24 months of a COVID spun up again. You see what I'm saying? So no, it's not just about only offsetting your taxes. We have to be strategic. Some years it might make sense for us to be forward thinking and to focus on tax planning. And some years we might want to take our foot off the gas pedal, pay a little bit of tax, be a little bit more liquid. So this is a game that we play year in and year out.
And that's why you need a good tax strategist.
Yes, that's why you need to know the differences between a tax accountant and a tax professional and then partner with the right people in order to get the help you need.
AKA www.taxalchemy.com, right?
Yes, sir.
Yeah, heck yeah, bro. Talk to me about watches like Rolexes, you know, Richard Milles, right? Like you see, the amount of young people, do young people ever think they can write this crap off and try to get away with it?
Young people try to write off Rolexes, APs all the time because they're doing videos with their watches on and they're talking to a demographic of clients.
Marketing.
And it's marketing. It's part of my brand. Of course it's going to be a write-off. The more I wear this, the more I have my Lamborghini, the more clients I'm attracting. I literally can see it. I see it inside of my Stripe account. Guess what? IRS doesn't care about your Stripe account, buddy.
Yeah.
They don't.
Yeah.
They care about facts and circumstances. Okay, Karlton, let us know why he decided to buy the watch. Is he in the watch business?
Right.
No, he's running a life insurance agency, or he's an Instagram influencer, or he's a real estate agent. Oh, okay, interesting. So him having that watch, explain to me how it's ordinary for a real estate agent, necessary for a real estate agent, and reasonable for real estate agents to make money by having Rolexes that cost $100,000. Explain it to me, Karlton. And then now I have to, because the client doesn't know how to do this, try to come up with facts, circumstances to substantiate why we spent the money on the Rolex.
Right.
And this becomes so hard to try to prove to the IRS that you had a legitimate business intent of buying this to make money. The people that are able to write off watches are people that are in the watch industry, brother. Yeah. If you're a watch trader, you have a watch YouTube account and you're sharing with people about how you can do watch trading, you could hold watches as inventory. And even if they're held as inventory, you're still not writing them off. They're held as inventory. So this is where I want people to kind of get that clarification from me. And I've definitely put in things out there before around how you can strategically get yourself to be able to write off a watch. But I don't want to have somebody to think just because I'm doing marketing or I'm wearing a watch, I can write it off. You have to be in the watch industry or have a watch brand in order to be able to carry watches as inventory.
Totally. Because otherwise the IRS is going to say you can tell time on an Apple Watch.
Exactly.
Why do you need a $100,000 presidential or an AP or whatever?
Go get a Casio.
Right. Literally.
Yeah.
You know, a G-Shock. Remember the G-Shocks?
Yeah. Oh, yeah. 100%. I remember that. Bro, people used to load up on G-Shocks.
Literally. I remember
load up on those, man.
For sure. What do you think the number one mistake that people make on their taxes that causes audits?
The number one mistake people make on their taxes that causes audits is omissions. They leave things off of their tax returns. You received a 1099 and you forgot to report it. You had 11 K1s and you only reported 9 K1s inside of your tax returns. Omissions are the number one way people get flagged and then audited by the IRS because you're underreporting income. The next is making a mistake on a tax return. It's very easy to make mistakes on tax returns when you're somebody that's new to filing your own tax returns, or you're a CPA that's extremely busy. Most CPA firms that are really good firms will separate tax prep and tax review because mistakes are so easy to have happen on a return. You forgot to tie something out exactly on the balance sheet, so things are just falling apart on the return without you really kind of seeing it because the system can't flag it, right?
Got it.
So this is why sometimes CPAs will have professional reviewers whose sole job in the CPA office is just to review returns. They don't even file returns.
Got it. That's crazy. A little mistake can cause an audit.
Yep, absolutely.
Can you do everything perfect and still get audited?
Oh, absolutely. Yeah. Just because your tax return doesn't have mistakes or omissions, or you're not using, weird categories, doesn't mean that you can't get audited. Audits are 100% random. The IRS has to conduct audits as a part of what they do every single year. You're just more likely to get audited if you make more income. And really, audits really start to become a bigger deal when you're over 10 million.
Interesting.
Not
Why is
as
that?
much because IRS legally has to audit people who are making more income. They have departments specified for incomes over 10 million and then incomes over 100 million. They have special units inside of the IRS division for business owners that are explicitly making over 10 million, or taxpayers that are explicitly making over 10 million.
Wow.
It's a whole nother unit, whole nother department.
Gross or net?
Growth.
Gross.
Yes. Gross.
On the business or on the individual?
Both.
Both.
Yes.
Wow.
Absolutely.
So I'm already in that category.
Yes, you are, and so am I.
Dang. You gotta love that. Well,
So our audit risk just jumped up to around 2%.
Okay.
Yeah.
Interesting.
Yeah.
Now, the previous administration, they wanted to hire a bunch of new IRS agents, but the current administration, they did away with that, right?
Biden wanted to hire 89,000. It was some arbitrage number, something crazy. And Trump was like, yeah, hell no. We're repealing all of this back. By the way, all the funding that Biden and we were going to send over to you guys, we're not even sending it anymore. We're just parking it until we figure out what to do with it. So right now, the money that the IRS was going to receive this year in government funding is literally just sitting in a cash account.
Wow.
Right now, a money market account. Not given out to the IRS. Pretty
That's
awesome.
Crazy. Yeah.
I love it. I don't think the IRS needs more funding.
No, I don't think so
I don't
either.
think they need more funding.
Right. I mean,
I think they need is more technology. They need to get faster.
They need to be efficient.
They need to be more efficient.
Dude, I mean, anytime, like, I pay the IRS, like, fairly often, right?
Yes.
And I'm always like, what's my balance? Like, what do I owe? Like, where do I look? Like, I go on their website. Like, it's so clunky. I can never find what I'm looking for. I have to, like, wait for the letter in the mail to see what the hell it's old school, dude. It's like
Super
dinosaur
archaic.
world.
You have to call in.
Yeah.
You have to wait. You get transferred, and then you're talking to somebody that doesn't know what
They don't know anything
They
about
don't know
anything.
anything, so then they transfer you to somebody else. And then once you get the answer, and they tell you, okay, I only solved these problems, so I'll transfer you back to this department. And then you go back to that department, they tell you, okay, in order for this other department to know, it's going to be another 60 to 90 days. It's just our process. You're like, oh.
It's crazy.
Oh, great. Thanks. I didn't know that you guys take 90 days to do anything. To turn one corner.
Do W-2 people get audited more often or less often than 1099?
Oh, they get audited 100% less often
Really?
than 1099.
Yeah.
Because
what is there to audit? Is that kind of the mindset?
It's not what is there to audit. It's where's the substance. It's very easy for a business owner to make a mistake on a tax return. It's harder for a W-2 taxpayer to make a mistake on a tax return because all you're inputting is just a couple of lines from your W-2 into the tax software.
Sure.
I mean, brother, you just got to read legibly. AI could even take a scan of it and part the numbers into the software for you now. I mean, it's really hard to mess up a basic W-2 tax return. When W-2 taxpayers start to get a lot of investments, okay, your tax return becomes a little bit more complex. Maybe you have a couple investment properties. Maybe you have a couple of brokerage accounts, so you have capital gains and stuff. But with business owners, you have K1s. With business owners, you have assets that are on the books. With business owners, you have balance sheets. With business owners, you have payroll. Right. With business owners, you have to calculate deductions and QBI and what qualifies and what doesn't qualify. And when does he get disallowed? Did he not get disallowed? What type of income is he receiving? Is this service-based income? Is this non-service-based income? It is so much more complex, so much more complex. So yeah, absolutely. I'd spend more time auditing business owners because there's more opportunity there.
Totally. Yeah. More things to catch.
More things to catch.
Right. At the end of the day.
Yep.
How often do you see people actually go to jail, like for being for tax evasion and stuff? Like, is it because like the movies and stuff, I feel like the society kind of scares people a little more than maybe what it actually looks like in real life, right?
Yeah,
like when you get audited, you just have to go back and show them everything, right? Like unless you're running a Ponzi scheme.
When you're committing tax fraud, is when you go to jail. When you're intentionally getting over on the IRS.
So if you accidentally screw up.
No, people make accidents all the time. I didn't know. That was negligence. I didn't know. But people who incriminate on their tax returns, I'm literally changing my books intentionally to underreport, so I literally pay less. Bro, you're a criminal.
Totally.
That's criminal. And the Christies went to jail for tax fraud and tax evasion, and they recently got a pardon by Trump, which I was like, whoa. That was where I was like, he must know something I do not, because the tax code's the tax code, bro.
Right.
Like they committed tax fraud, and primarily they committed tax evasion, but yeah, they got a pardon. That was the most recent big story that I've seen of somebody going to jail. I've never had a client or anybody that I've ever come into contact with that has been in trouble to the point where the IRS is taking them to jail. I've had a client that was getting assessed for 10 years of $8 million in taxes. And even the IRS was still willing to work with him, even though he hadn't filed returns in 10 years. Like, if you're still trying to stay in touch, they understand you're going through an economic circumstance. You have to start communicating with them and figuring out a plan. That's why they created these two different options. The IRS has two options that you can utilize. They have the offering compromise option, which means that you're working with them to come up with a compromise on how much you can pay them because your financial circumstances have changed, and they need to see that. They're going to request all your finances. They're going to request bank statements over the last couple of months, maybe in the last couple of years. And they want to see, okay, does this person's income drop, or did his debt rise enough for us to understand that him paying us back is going to take a lot longer than we think it's going to take. So it might be in our best interest to really just compromise with him on a far reduced amount and have him either pay it in a lump sum or on a payment plan. So that's what's called an offer and compromise. And then you have payment plans. Payment plans is where the IRS says, okay, you can pay me back over the course of 5 years, but guess what? The only way you qualify for a payment plan is if you get your tax balance under $50,000. And so big business owners that have huge tax debts, man, they're on the hook with the IRS for those penalties and interest fees because they can't get on a payment plan because they're not under 50K. So they're just letting that balance just trickle and trickle every single month. They're just trying to chop at that tax debt.
Right. Yeah. So what I'm hearing is the IRS they're human beings at the end of the day, right? Like they have a heart and a soul.
Yes.
And like if you're a good person trying to do the right thing and you had a bad chain of events happen to you, like they will work with you.
They will work with you, absolutely. And this is where you can also get counsel as well. There's tons of representation firms out there that will essentially do 100% of the communication and consulting for you. They'll get a power of attorney and submit it to the IRS, and now they get to talk to the IRS on behalf of you. So they'll communicate to you saying, hey, here's where we're at. I'm working with this person. We're waiting on status. Can you send over this? Can you send over that? And it's just this back and forth game.
All right, I have a couple more questions and then we'll wrap. So one of my questions is, if you get audited, what should you do? Like, what's the first, if you get arrested, you're like, I want to call my lawyer, right? If you get a letter in the mail saying you're getting audited, what's the first thing you do as a high-level entrepreneur?
You call your CPA immediately. This is not something for you to handle by yourself. You're going to immediately call your CPA or your enrolled agent, get them on the phone, and get them the IRS audit notice to them as soon as possible, and then go in your mail and see if there's been any other letter sent to you. Because typically when you get an audit, they probably have already sent you a notice ahead of time, and now you're getting audited. Like, normally you get a notice first questioning something, and then you don't respond, and then they send another notice saying like, hey, we're by this date, or we're going to go into a formal investigation, and then you get the formal investigation audit.
Got it.
So you typically missed a couple of pieces of mail by the time you're getting audited. So I would say get all of that mail over to your CPA. Get on the phone with them, and what you're going to do is you're going to have your CPA tell you what does the scope of work look like. Is this going to be 10, 15, 20 hours? They'll kind of let you know how they bill. You'll go into a formal engagement with them, sign a power of attorney, and then now what they're going to do is they're going to get on the phone with the IRS and figure out who's the agent that's been assigned to you. And they're going to give them their CPA or enrolled agent number, and they're going to say, okay, talk to me a little bit about what's going on and where we're at. And then this is where it starts. We're questioning these things. They have the conversation. And now your CPA or enrolled agent can go back and forth now to figure out how much information do we actually have to share relative to this audit? Or can this be solved without us having to turn over stuff, right?
Sure.
Now you're in a battle.
Yeah, so don't do it by yourself.
Absolutely not. With the IRS, you're not innocent until proven guilty. You are guilty until proven innocent.
Yep.
So if I'm taking that stance in an area that I do not have a degree or background in, highly recommend that you get a tax professional to do that for you.
You need it.
Yes.
You have to have it, right?
Have to.
One of my last questions is, I want to talk about, a liquidation event, right? It's something that personally applies to me. It will apply to me in a couple years from now. You see these guys that they get acquired by private equity or something like that, right? And they get $50 million, $100 million, $150 million payout, right?
Yes.
What do these types of people do in that event? Because, correct me if I'm wrong, it's kind of like winning the lottery, right? Like, you have this massive amount of money coming in at one time. Are there ways to minimize that? Like, what do these guys do?
There's tons of different ways, and there's different ways you can skin the cat. It really comes down to how much time you have before the exit event is going to happen. Before the exit event's going to happen, and how big of an exit is if it's going to be.
Yep.
Some people who have a good amount of runway time that may not have a big exit, we might look at transitioning their corporation over to a C Corp.
Okay.
Because if you have a 5-year period, you can sell a C Corp under this IRS code called a 1203. You could sell the C Corp up to 20 million tax-free. So essentially the gain that you receive on the sale of your business would essentially be tax-free as a C corporation if you held on to your shares over the course of 5 years.
Got it.
So pretty awesome, but that's not everybody. And maybe you don't have the time period to switch over to a C corporation. And maybe you're having a bigger exit event. Maybe you're going to have a $100 million exit event. Well, if you're going to have a $100 million exit event, you're going to be in a place where you're going to have eventually estate taxes to worry about for your heirs that are going to inherit all of this wealth. What most estate planners will tell you is, we should probably look at doing estate planning now in preparation for the liquidation event. How can we start transitioning some of the shares that you own into possibly an irrevocable trust, get it completely out of your state so you're not going to owe taxes when this exit event happens because you don't have ownership over those shares. So now it's almost becomes like an installment sale, right? Maybe you do choose to retain some of the shares that you are going to have liquidity over versus having some of the shares go into this irrevocable trust that you know is just going to be legacy money that's going to go to your family members. That's one way in which a lot of people go through an exit event while trying to mitigate their taxes is retaining some of the shares and also moving some of the shares into an irrevocable trust. Now, what if you want some liquidity and you want some cash flow, even though you're not going to have the business anymore? This is where we look at a charitable remainder trust. What a charitable remainder trust is it's an irrevocable trust that you would establish that is set up with the intention for it to take ownership over your interest, and then it sells the business to the buyer for you. Because it has 100% ownership over your interest, it doesn't experience any taxes when it sells. But in order for you to have liquidity, what you do is you have the charitable remainder trust purchase an annuity policy. Now it's become a charitable remainder annuity trust.
Got it.
A CRAT can pay you over your lifetime, maybe even till the end of your lifetime, at 8 to 10% of whatever this liquidity event is. Maybe it was $100 million and you want to get paid out 8 to 10% a year of $100 million, $800 to $1 million a year. That's awesome. That's great money for you to live off of. Well, this charitable remainder annuity trust can just pay you 8 to 10% for the remainder of your life. Charitable remainder annuity trust. Okay, well, Karlton, what happens to the remainder of all the assets that are left inside of the trust? It goes to a charity that you have defined as you have set up this trust, or you can choose to define which charity you want the remainder amounts to go to later. Also, your children could possibly be a participant of that trust. Maybe it's a foundation that you also have ownership over. There's different ways in which you could play the game.
Sure.
Yeah, but these are some of the things that, our clients take into consideration. Another strategy that comes into my mind, not that I want to show my expertise, but I want to show the options that are available, is a deferred sales trust. You can roll over your capital gain into a deferred sales trust or a Delaware statutory trust. It's just another vehicle that allows for you to offset your capital gains and possibly open up some liquidity for you to be able to experience a much lower tax bill than all of that money coming to you at one time.
Got it.
Let me know if this makes sense.
It makes all the sense in the world, right? And I think the main takeaway there is prepare.
Yes.
Right? Like if you think that you're going to eventually sell or get acquired or have some type of event like this, like you need to not wait until the month before you're in, you know, the talks with private equity or whoever it's going to be, right? Like you need to 6 months before, a year before, 2 years before, whatever, start thinking about it. Talk to guys like you, estate planners, whatever, right?
Yes. You're always going to, and this was taught to me, always build a business with the end in mind.
Totally.
Right?
Yep.
You're always going to have a business that you can exit, even though you may never want to exit. So think about the exit from the onset. And if there is going to be an exit in a 5-year horizon or a 10-year horizon, who are the people I need to consult with right now that it would be able to mitigate a big exit or liquidity event that I might have? And what are my options available?
Totally.
Because when you have that event happen and you're only 6 months out from it actually happening, you'll realize your options have been dwindled down because you didn't give yourself enough runway time. But if you give yourself a year to 2 years, oh my gosh, the options can be endless on what you can create or set up.
I like that a lot. Okay, last question for you.
Yeah.
Art.
Yeah.
Talk to me about art. You hear about wealthy people buying $5 million pieces of art. You see it in movies even, right? Like you go watch Billions, you see Bobby Axelrod, whatever it might be.
Yeah.
And you see people that are doing things with art. Talk to me about that.
Yeah. So I think a lot of people see now that wealthy people are purchasing art and they're getting this artwork or sculptures appraised, which it's so funny because artwork is so arbitrary.
Right.
Like, you could buy a piece of art for $100,000, and to you, it may only look like it's worth $10,000, but to an artist, it's actually worth $2 million the next day. It's crazy how art works. But the cool thing is art can be donated after it's been appraised. And so if you're somebody that's sitting on a lot of wealth, one of the tax plays that you can look into is acquiring the right type of artwork, getting it appraised, and then making donations of the artwork, right? Because essentially it's like making a down payment on something that you get to write off that's bigger than what you spent money on.
Right.
Kind of like putting a down payment on a car and writing off 100% of that purchase price, like we talked about earlier.
Sure.
Same thing with art. If I buy a piece of art for $100K and it gets appraised for $1 million, I'm getting $1 million write-off, not $100,000 write-off.
You only spent $100,000.
And I only spent $100,000.
Right.
So for someone who's a wealthy entrepreneur, how they view this is, well, Karlton, what if I spent $100,000 and it appraises for $1 million instead of just giving it away to some other, museum or charity? I just donate it to my own foundation.
Yeah.
Now the artwork sits inside of my foundation as an asset, and I never had to donate it out to someone else. It's sitting in my control.
Right.
The IRS will allow for you to do this, and you're able to roll over 30% of cash of your adjusted gross income into a private family foundation for a year one tax deduction. 5% of the foundation's charitable assets have to be donated out to another qualifying 501c3 of your choice. So if I have $1 million sitting inside of a charitable foundation, only 5% of that piece of artwork, 5% of the charitable assets has to be donated out, but I own $1 million piece of artwork and I got $1 million deduction possibly.
Super cool.
Pretty awesome.
I feel like there's levels to that game in particular.
Yes, absolutely.
Like you can get in that world and really, if you wanted to, you had the money.
Yes, the art world is crazy, and so is the nonprofit world when you really start looking at it.
It's a wild world.
And I think it's cool because the more I stare at some of these really big wealth players, I'm talking about, the Bushes and the Trumps, they have, and Bill Gates, they have these big billion-dollar foundations, man. And these foundations aren't just giving back. These foundations own massive amounts of farmland, assets, real estate, and artwork and precious metals.
It's crazy.
Yep.
Okay, final question for you. Brand new entrepreneurs, watch them right now. They're starting their business. They want to rock and roll. They want to make a lot of money one day. Number one piece of advice.
Number one piece of advice is make sure you have the right tennis shoes. When you get started out, you're most likely going to be in an LLC, but those tennis shoes are only going to run you so far. Eventually, you're going to bust out of the seams. You'll bust out of the seams right around $50,000 in net profit. Okay. This is when I want you to look into what's called a subchapter S election. By filing a form 2553 with the IRS, you don't have to do it. Your tax professional can. You're switching over to an S corporation. Now you're splitting your income into two different parts, salary and distribution, eliminating self-employment taxes on the distribution amounts. This is going to save you 15.3% on whatever you didn't give yourself in a salary. And for new business owners, it's a must.
I love that. It's phenomenal. And who do they go to figure that out and or get it set up?
Yeah, you guys are more than welcome to come to our website, www.taxalchemy.com. Get in touch with us to get any help when it comes to setting up your entities or doing tax planning services. And if you're a business owner that's making over $300K, we'd love to create a projection for you to see what's possible.
Guarantee you we'll work together in the future.
Oh, without a doubt.
Yeah, for sure. Taxalchemy.com. Where can people find you on social media?
You can find me at Karlton Dennis on all social media channels. Feel free to check out our YouTube too if you're new to the tax and accounting space, and then taxalchemy.com for tax services.
You have a phenomenal YouTube channel. Anybody watching should go check out his YouTube channel. Literally anything you can think of, you can find it on his YouTube channel, and I love that about you.
Appreciate you, man.
Appreciate you coming on the show, bro. Thank you for staying to the end of the podcast. I greatly appreciate it. If you haven't done so already, go check out Karlton Dennis. All of his stuff will be down in the link in the description below. And if you haven't done so already, make sure you subscribe to my YouTube channel and go check out all of the other amazing content that we post on my channel. We put in a ton of time, energy, and effort into it. We'd love your opinions and your thoughts. Make sure you subscribe. Appreciate you, and we'll see you in the next one.